네, 긴축 불확실성이 커져가고 있는 가운데 미국에서도 기업들의 실적 발표가 이어지고 있습니다. 앞서 글로벌 시황센터에서 코카콜라 이야기도 좀 해드렸지만 현지 미국에서 이 월가에서 기업 실적을 어떻게 분석하고 있는지 굉장히 궁금합니다. 현재에 계신 버니씨의 의견 들어보도록 하겠습니다. 함께 만나보시죠.
Let's now have a thought discussion on earnings changes, then the perspective of earnings, and interest rates. We know the Fed's raising rates, but we also want to think about not just where short-term rates are, but where long-term rates are. Because long-term rates have the biggest effect on high beta stocks, on technology stocks, on those kind of stocks, the long-term plays. Because if you think about a technology stock, it's like a bond with an infinite level of interest payments, and it has a big beta. In other words, it moves much greater than the market moves. So if stock market's down 5%, technology stocks might be down 15%. If the stock market's up 5%, technology stocks might be up 15, 20%, that sort of thing. So let's think about earnings changes and what's happened overall in the stock market. And Citibank does this earnings surprises. In other words, they look at all the earnings that comes out. Did they beat expectations? Did they underperform expectations? Was there negative guidance going forward? In other words, the company's saying, I think we're going to have a slower and slower revenue growth down the road, or positive guidance. I think revenues are going to pick up. I think earnings are going to pick up. We're very excited down the road. Companies that don't accurately reflect guidance down the road lose a lot of credibility, and their stock really gets hurt because of that. So it's always good to be forthright and to be able to explain things. People have tried to cover it up, and then their stocks completely fall out of favor because the analysts and the actual investors, institutionally in particular, are pretty savvy about what goes on. So this is earnings expectations, and what we can see, and this was COVID right here, obviously people were thinking, okay, here's things going on, here's things going on, and then COVID hits and everybody underperforms because we're locked in our homes, our apartments, that sort of thing. We don't drive very much. Our kids are not going to school. We were not able to go to stores, that sort of thing. We couldn't use restaurants. So we underperformed substantially. Then we come out of COVID, and what happened was our economy was more resilient than we ever thought. The third quarter and the fourth quarter of last year were really positive, relatively speaking. So all of a sudden we have all these positive earnings surprises. Now the fourth quarter started, okay, we get those earnings releases in the fourth quarter in, say, January, February, and we have more and more companies saying, I think our growth is slowing down, I think our growth is slowing down, and we're now seeing a negative earnings surprises. So more people are getting surprised on the negative side. There's fewer and fewer positive guidances relative to negative guidances going forward. So you've got companies that say, I think our revenues are going to be not as strong a growth in the next, say, 6 to 9 months, or 6 months to 1 year out, as we have experienced prior to that. And they may have experienced 30% revenue growth. They may have experienced 15, whatever it is, they want to be able to tell people that they're not going to see the positive revenue growth in that same acceleration phase. And so what happened to those stocks? Those stocks went down substantially. And I brought this up time and time again. Shopify, great company, 1,500 down to 500 almost. Upstart, Bill.com, The Trade Desk. You can think of so many stocks that went down substantially during this period of time because we gave them guidance that was basically trying to infer that our revenue growth could not sustain itself at the pace that it was at before. But now what I think is going to happen is, that's great. Let's go past this. Let's go past when they released the first quarter guidance in April and in May and look forward, let's get into the second half of the year. And I think we're going to probably tilt back up because we've indoctrinated so many people into this slow revenue growth that if we can get revenue growth to start to go back up again, we're going to have a bunch of positive experiences. And the stock market is pretty well correlated to positive earnings expectations. Now, what we've also had is we're at the beginning of our rate cycle. Okay, we've had our first rate increase. Interesting to note, the last time we had a Fed tightening cycle, so we've had 88, 94, 99, 2004, 2015, and now. Okay, every one of those times, and we've had low target rates, in other words, the Fed funds rate has been fairly low. Okay, or we've had higher target rates. But all of these, before we see our first Fed rate hike, we were all positive returns on everything, or not marginally negative returns. Now we're down 10, down 17, down 11% in the S&P 500, the NASDAQ, and the Russell 2000. So what we did was we anticipated the negative effects of a Fed rate hike environment already before we ever saw any of them happen. So that's why sometimes you can sell the rumor by the fact, and I think that's one of the reasons that the stock market rallied so significantly right after that first rate hike. Now, let's think about the fact that the Fed is not perfect either, okay? The Fed is responding to things as they see fit. They get very concerned. We have hawkish Fed governors, and we have dovish or more positive Fed governors. So that, in other words, we have people that want higher rates to stem inflation really fast, and then we have other people that are more concerned about full employment. As a Fed governor, we have all sorts of different ones in here. But what we've seen over time is that there's been a bunch of Fed tightening moves over the last, say, 50 years. And once we have a tightening move end, how fast do they go and they start to lower interest rates? In other words, they overcompensate and they provide much more liquidity down the road right after that. So we go back and we look at these. In 1973, 2 months after they stopped raising rates, they lowered rates. In 1979 and in 1980, 1 month after they stopped raising rates, they lowered rates. They sent them back up here. This was the ultimate bottom of the stock market. This was when Dow Jones was trading around 660. But 2 months, 4 months, 5 months, 8 months, 15 months, and 7 months. Now, these are longer, but they're also coming from levels that were nowhere near as high as these interest rate levels were back in the 70s and 80s. So what we know is that the Fed can make mistakes. The Fed can over-tighten, over-ease. We've seen the over-easing. We saw the liquidity pour into the market after COVID. We saw a stock market rally from the middle of 2020 through the end of 2021 that was pretty unbelievable. Very little, no 5% price declines during that whole move. Now we get them all thinking, hey, we have full employment, we have too high inflations for all sorts of supply shock reasons, which may or may not wind up staying with us. I don't believe they will in the second half of this year. And we're going to see a Fed that maybe raises rates too much and then has to provide liquidity back into the market again. So I think if we think about things in a big picture, we're in a long-term bull market. And within those long-term bull markets, we have significant price declines that allow us to be able to purchase stocks at more attractive prices. I think for the rest of this decade, it's a bold statement, and I don't necessarily have to back it up. But my personal belief is that we're in a long-term stock market rally because we have a great workforce, a demographics that we've talked about before, where we have a high percentage of people between, say, 30 and 45 years old, which are the drivers of the economy. They provide revenue into the economy as opposed to the older generation that takes revenue out of the economy because they don't work if they're retired, and the younger people that consume and don't save anything. So I think that given all these things and the technology and the growth that we're going to have in technology over the next, say, 3 to 4 to 5 years is part of the reason that we're in this long-term growth phase. So demographics, technology advances, those things are reasons that we can see price declines in the market and use those as buying opportunities.